Good afternoon, everybody, and welcome to today's webinar on future scenarios for South African coal, exports and Eskom, hosted by African Source Markets in partnership with Creamer Media's Contract Publishing. Thank you for taking the time to join us. We're looking forward to hosting you. I'm Shannon Derejo from Creamer Media's Contract Publishing, and I'll be your host this afternoon. Today's webinar will explore some of the key drivers and issues facing both domestic and export coal markets and considers the changing South African landscape as both production and demand start to shut down. We will also consider issues around the just transition and whether the weak South African rand will continue to save South Africa's coal miners. If you're interested in the future of the South African energy sector, stay tuned as we explore some of the likely pathways from 2020 to 2040. Please note that the Q&A function has been enabled, so please post your questions into the Q&A box, which you'll find on the panel at the bottom of your screen. We'll attempt to answer all your questions after the presentation. And if you miss anything during the presentation, don't worry, we're recording the webinar and we'll be sending you a copy of the recording afterwards. We are also streaming the webinar live to the Mining Weekly YouTube channel. So let's get started. I'd like to introduce today's speaker, Bevan Jones. Bevan is the CEO at African Source Markets, which assists clients to originate resource finance, broker commodities, and find offtake partners, and then finally assist with innovative mine closure and restoration to create further value. Bevan graduated as a South African mining engineer. He moved to London in 1998, where he co-founded Global Coal, an online physical coal marketplace. From there, he moved into commodity trading, working for investment banks, including Macquarie and Rand Merchant Bank, before returning to South Africa in 2008. Before founding African Source Markets, Bevan worked for Tebe Investment Corporation, where he helped structure commodity trading ventures with Shell, assisting with mine finance and overseeing several venture capital initiatives. He'll be discussing future scenarios for South African coal, focusing on exports and Eskom and some of the likely pathways from 2020 to 2040. Over to you, Bevan.
Thank you, Shannon. Thanks very much. And it's a pleasure to be here. And I'd just like to welcome everyone. I see we have a range of attendees today. And it's good to see we've got people from government and we've got people from the mining industry, traders, international and local utilities, and we've even got some climate advocacy groups and mining suppliers, so a broad range. I hope everyone will find something useful today. Shannon, I just need to share my screen. Can I do that?
Yes, please do.
Great. I think you have to select all panelists need to be able to do that. Yeah.
Oh, I'm sorry. Let me.
And I see just briefly on my bio before I joined Tebe, actually, I also worked with London commodity brokers in South Africa and did some interesting things in coal there as well. And I see some of the guys from London commodity brokers are on today's session as well. So welcome to everyone. Right, I'm going to go ahead. I seem to be having a problem sharing the screen, Shannon. Is it?
Right. If you want to, I'll just open up on my side. I'll share from my side.
Yeah, maybe that's a good idea then. Thanks. I'm going to mention a little bit about source markets as well. But basically today we're focusing on our research offering. And we also are able, though, to, as Shannon mentioned, we can assist clients. We're wanting to assist clients in the full life cycle of their projects, which is basically originating resource finance, brokering commodities, and then ultimately helping to do proper restoration and rehabilitation work. Ideally, what we want to be able to see is a transparent, robust commodity market for South African commodities. And the point was that we really wanted to look at empowering junior miners so that they can get onto a level playing field with some of the larger trading houses and the mining companies out there. And we think that developing I've believed this for a long time, but we think developing a domestic South African marketplace for coal and also other commodities such as chrome, etc., would be the way to go in that. Shannon, if we can just move on to the next slide. Right. Okay. Is it showing okay for you, Shannon? Is it showing okay for everyone? Or are we just...
I can see it fine.
Okay, perfect. You can see the slides. Okay, so we now, before we start, I want to look at the RB1 price history. And what we're looking at here is a graph of the RB1 price really since inception in 2001. As Shannon mentioned, we started Global Coal in 1998 in London. And what we did was we started with the ARA, which is Amsterdam, Rotterdam, and Antwerp, and the Richards Bay coal market. So we developed the RB1 index and the ARA index, which really got going around 2001, even though the company was started in 1998. It took us a while to get our systems going and to get up and running. And when we were starting, there was also another gentleman starting, a gentleman called Jeff Bezos, starting a little known company called Amazon at the time. So we've all come quite a long way since then. Right, so what Global Coal did was really change the game by introducing these standard qualities, being RB1, ARA, and ultimately Newcastle as well, or Nuke. And if we can move on to the next slide, sorry, Shannon, before we move on to the next slide, if we can go one back, let me walk you through some of the major events that happened in the RB1 price history that has unfolded. So basically, if we look at this graph, we can see from 2001 to today, we are looking at basically a 4% annual inflation. Although obviously the volatility in the market since then, in between the years, has been quite extreme. Some of these events, some of the major ones are obviously the Chinese commodity boom, which really got going around 2006, 2007, when China became a net importer of coal. That was obviously followed by the great financial crisis or the credit crunch of 2007 and 2008, when coal dropped right back to where it had almost started. We then saw over the next couple of years what is a classical technical analysis term, or a 50% retracement, when human beings like to feel that they've reached a sort of a point where they can feel this is okay and price feels reasonable about these levels. But then since then, the sort of theme, or the end of the commodity super cycle started to take place. And we also saw China flexing its muscles a lot more and starting to produce its own coal and become a little bit more self-sufficient. Then, of course, 2015 really started seeing the first of the sort of like climate pushback, you could say, and people starting to divest from mining activities. And that has obviously gathered pace over the years. And the price has subsequently rallied, but what we've seen recently is that has really taken off, and the climate change movement has started to pressure funders specifically to shut down coal plants. And that obviously has a knock-on effect in terms of shutting down coal mines and divestment, etc. So we're sitting in a very bearish position at the moment. But that's an overview of the last 20 years of the price. If we move on to the next slide then, Shannon, we can see what the price has actually done in rands. And this is why we say, will the South African rand to continue to save South African coal miners? Because if we look at the same price, the RB1 price, but we now look at it in rands per ton, we see that actually has given us about a 6% annual growth rate. And there the price doesn't look too bad compared to historically where it's been in the past. So will this continue? Will the rand continue to weaken, or will it start to strengthen? If we assume that the US dollar will collapse at some point, what will happen to a basket of commodity currencies like coal, like oil, natural gas, which are all priced in dollars? Or will the rand continue to weaken even if the dollar collapses because of the general risk-off environment? In this slide now, we look at some of the typical suspects of what drives the price of the coal market. And of course, we have to look at the supply and demand fundamentals. individual miners are obviously going to be influenced by their position on the production cost curve. And countries such as the USA, who have typically been a swing supplier, can affect the price. So typically when coal was pricing into Europe, the United States would be able to come in and cap that price, because when the price was good enough, they would swing their supply from domestic supply in the States into Europe. That obviously doesn't happen much anymore. We also see freight prices, so bulk freight prices, both in terms of Panamax vessels and Capesize vessels, playing quite a large role in terms of FOB prices versus CIF, or cost, insurance, and freight, or delivered prices. Of course, we see from time to time in the news price shocks. So whether it's a derailment in the RBCT line, or it's a strike in Colombia, these tend to be bullish price shocks. Of course, then coal, it doesn't exist in isolation. It has to compete against natural gas. It's also competing against other fuels, more specifically renewables lately these days, as well as nuclear, etc. But really in Europe, we look at gas switching, where they look at the clean spark spread for gas versus the clean dark spread for coal. And of course, when we talk about the clean spreads, we're factoring in the CO2 price, or the price for carbon. So the carbon market has always becoming more important now. I think over the last few years, carbon prices were quite bearish, but now they seem to be on the rise. Weather and seasonality have also been big factors. So for instance, you would have a heating season or a cooling season in the Northern Hemisphere. In India, you would have monsoons that would affect the price, and buyers would want to buy before the monsoon. And in China, for instance, you also have hydropower. We've seen massive floods in China recently affecting arable land, but also potentially affecting the Three Gorges Dam. And when strong hydropower is happening in China, there's weaker demand for coal. Then, of course, you have your technical analysts and your trend followers, and all of those people will also drive the price for coal. If we can look at the next slide, Shannon, it shows us some of the other influences, because physical coal is one element of the story, but there's also financial, or what we call paper trading. And there, as I've mentioned, the paper traders on the utility side specifically will trade the clean dark spread, which really represents their profit margin between the price of buying coal and the price of selling power. We will have miners who will look at hedge their forward production. We will have people trading the various spreads. So when we look at the RB1 versus the RB3 spread, we're looking at a quality spread. When we look at the Richards Bay versus Newcastle spread, we're looking at what's called like an FOB spread, the difference between South African prices and Australian prices. And then something like the API2 or the API4, which is financial coal, that's an implied freight spread, which represents effectively the C4 freight route between South Africa and Europe. So those are the various types of product spreads. And then you also have time spreads, where traders will trade out on the forward curve. They might lock in the margin that they can get from a far out position versus a spot position, for instance. We also have option trading, and option traders will delta hedge their underlying position in the market. We have speculative traders who go out on a whim, try and make a margin from a speculative position. And of course, we have people who will climb on board with any long or short squeeze if someone has a distressed cargo in the market. So all of this noise adds to the overall sentiment and the overall position that coal itself can take. If we look at the next slide, we'll see the difference, the relative difference in size between, say, the actual physical seaborne coal market and the paper coal market. Now, most mature markets like crude oil, for instance, the paper coal or the financial market is around 10 times at least the size of the physical market. Coal hasn't quite got there. I'm not sure it will, but the paper coal market is definitely higher than the current physical market. And from what I understand, if we look at this, the relative sort of split in terms of the different areas traded in the physical market, we can see that Newcastle and sort of other Asia, Southeast Asia, represent far higher volumes versus, say, for instance, European or Atlantic coal coming from RBCT or into Europe. RBCT or API4 is really the smaller of all of them. But nevertheless, it plays quite an important role between the implied freight and the FOB spread. So it does play a significant role. When we look at paper coal or financial coal, we also typically look at volatility, and that's come down after the COVID, March, April, from it was trading around a high of 40%. It's come down to a more sort of normal 15% now. And I talked about trading on the forward curve. The bulk of contracts traded in the financial coal market are what we would call calendar strips or calendar year. So 2021, 2022, 2023, trading forward and for settlement each month. Then we have quarters, which are the next most popular. So trading Q1, Q2, Q3. So there you would have 3 monthly settlements in the quarter. And then you have spot trades, which are really for the next sort of 3 months. So the current month and then the following 2 months. And the combination of all of that forms your forward curve. On the right-hand side, I've just included quite an interesting article going back in the archives from the history. This is the very first newsletter sent out by Peter Skeets, who was the originator of the API indices. And here you see it's the API1 index, which was published. And this was in April 1998. And we'll talk about that now if we go to the next one. What we're looking at here then is a typical forward curve for a market, not specifically the coal market, but it's just a definition of a forward curve and the terms that we should know, contango, being when forward prices are higher than spot prices. And this is normally the case for most commodity markets because there's generally a cost associated with storage and the time value of money. So you would expect future prices to be higher than spot prices, but that's not always the case because the market might spike or rally in the spot months, and then the traders might be more bearish about the future. And then that market is said to be in backwardation when futures prices are lower. At the moment, we're currently trading in a contango position, and we can see that in the next slide, which is part of our weekly report that we send out, and people can go onto our website and you can subscribe to this. This is a report that members specifically would get. And what we're trying to do is similar to what we did with Global Coal, where we are trying to not commoditize, but at least create relevant quality references which allow us to then quote prices on a much more consistent basis so that people can get an idea of where the price should be. We believe strongly in a transparent marketplace, and we think transparency is great for everyone. And of course, it helps to standardize, and it also helps the market because now we can look at just specific grades that the market can wash to. Instead of trying to wash to 101 different grades, the market can gain some efficiencies and some scale efficiencies. And it also helps logistics, of course, if you don't have to move hundreds of different grades. And it helps storage space at the mine and at the various ports if you're only managing a couple of specific quality stockpiles. So here we quote on a weekly basis the various prices which we are seeing on both a FOB basis and a free carrier basis inland at a basis around the Witbank area. And here we give an idea of historical pricing versus what we see the forward pricing doing. So we can see the difference in the forward curve between the various months. We look at 3 months ago versus what the forward curve is doing today. It's important to note that the forward curve is not a crystal ball. It is simply the market's composite view of where the market thinks prices are going in the future. Of course, the forward curve is almost always wrong. And volatility will impact significantly. The forward curve tends to approximate kind of an inflation-linked increase because that's what a typical conservative overall composite view would be. But at least it gives an idea of macro sort of trend. So we can see the current forward curve is that traders believe from the low position that we're at today, they believe prices will get better into the future. We will see. We will discuss this. So the other thing we need to think about is seasonality in the coal market. does seasonality still exist? And here we're talking about winter versus summer strips, for instance. What I've graphed here is a 15-year range of prices for the RB1 price. And basically what I've done is I've also then shown where we are today in terms of this year's pricing for 2020. So we can see we are trending very much towards the bottom end of the most recent, of a 15-year range. If we flick to the next slide, what I now show is a 5-year range. So in the 15-year range, we saw a peak in Q3. And we can say that the peak really was representative of European utilities possibly increasing demand in their summer, and it was a cooling demand for air conditioners, etc. However, what's happened in the subsequent period is obviously renewable power has come into the mix, and renewable power, especially solar power during the day, is more than capable of dealing with that increase in demand for cooling in the hotter months. You never really saw that in the winter months. Most homes in Europe and the UK, etc., are fueled and heated by gas. So it wasn't necessarily an electric demand that you saw. Anyway, that's my take on it. Some others say, well, maybe it's because everyone used to go on holiday in July, August in the UK and in Europe. But we can see that the latest 5-year range is a lot narrower, but there is a trend over the last 5 years for prices to rally into Q4. Now, if they're going to rally this year, they had better get a move on, because we are tracking very much lower than we have historically over the last 5 years. If we can then move on to the next slide. We are now in 2020. And many would say this is the annus horribilis for basically everyone. Or you could say it's a wake-up call for us, depending on which side of the curtain you sit. But either way, I think we have to realize that it's not only Greta that is angry. We are looking at our children, and we must also realize that captains of industry and serious investors are all finally starting to wake up and take ESG, or environmental, social, and governance factors seriously, even if much of it is still greenwashing. The coal industry must ask itself if it wants to go down in history as the villain, or if it wants to be a positive contributor to the change that is required. So if we move on now, let's look at some of the known unknowns that are facing the industry as of today. The first one, obviously, is the COVID-19, and there's a mixed recovery across the globe happening. South Africa experienced quite a harsh lockdown and seems to be coming out of it now, touch wood. Other countries are going through their second wave, and there will probably be a third wave and a fourth wave as we go into next year. But that seems to be the new normal. Climate and shareholder activism is continuing to curtail coal finance going forward. That's a trend, definitely. We've recently seen, obviously, the California blackouts, and some questions were asked then around the viability of an 100% renewable powered grid, with the intermittency factors, etc. We are literally a week or two away now from the US presidential election, and Joe Biden, who's currently the favorite, has a clear anti-coal stance. China is currently, after the trade wars and being blamed for COVID, it's very inward looking, but that's causing China to become very self-sufficient. Or will China revert to being outward looking and driving global growth again? A huge factor for the South African coal market is domestic Indian and Chinese coal production, which is definitely increasing, and the political willpower to do that is increasing. Then there is, of course, Southeast Asia, though, as well as China, who are continuing to build their coal-fired power stations, depending on finance, of course. On the home front, the big issue for us is that South African coal ownership and associated logistics will fragment further. The current spot price, as we know, is depressed. The Q4 rally appears unlikely, or at least late in coming. And then HELE technology, or high efficiency, low emissions technology, has been promised for a while, but we must also look at other uses for coal. These are becoming increasingly more vital for the survival of the industry. If we then look at the COVID recovery specifically, as the economies recover, this is clearly a bullish factor for coal. It's driving demand up, specifically as India recovers for South Africa. But of course, we will see third and fourth waves. Tourism and property sectors are likely to remain the hardest hit. Neither of those are particularly vital for coal. What has highlighted, for me at least, is COVID-19 has shown us the weaknesses in our food and water security systems. Energy security is obviously important, but when it comes to survival, food and water are going to be crucial. Now, commodity traders haven't reacted to the wave of easy money and quantitative easing and Robin Hood stock traders than say, for instance, Bitcoin traders have. Commodity traders tend to be a little bit more circumspect, but we will see the lockdown liberation feeding into a more bullish element. We may, on the other hand, also see people returning to more conservative ways. As we come out of COVID, perhaps moving back to an old school sort of business as usual approach. On the other hand, and a lot of people say this, perhaps we won't see that at all. Perhaps we will see increasing risk taking and an increasing realization that we need to focus on climate because of what COVID has highlighted for us. If we look at the next slide, specifically on climate activism, this is a bullish factor for the coal price. Why? Because it basically destroys production. So shareholder activism will drive and is driving the larger producers to exit the coal sector. By 2025, I believe, in South Africa, most large mining houses will have exited coal, except for Glencore, perhaps. But on that point, Ivan Glasenberg just recently made quite a good point. Ask ourselves, which is better? A responsible Glencore, for instance, running down its coal assets whilst restoring its mines and nature at the same time? Or should they cut and run and sell out to private investors who are not as impacted by shareholder activism? And those private investors will obviously seek to get the best returns from their investment, and they will seek to maximize production, which means coal will be around for longer. On the other hand, smaller private owners might not have the balance sheet to invest in exploration and the large-scale mine development that's required for long-life mines. Unfortunately, what this could lead to is a very quick and easy money approach where private interests will go for the easy surface tons in terms of creating hundreds of mini pits all around the area, creating untold environmental damage. And what that will ultimately do is probably lead to the sterilization of the larger underground reserves for good. So it's quite a complex issue, but I think on balance, the fact that we're driving out the larger mining houses will probably lead to increased fragmentation and an increase in the coal price. On the next one then, we look at the rise of renewable power. Now this is a specifically bearish factor because it destroys demand, not production. We saw in California recently with the load shedding. This is a picture of the bridge in San Francisco in dark, and you can see the stars. Although I'm not sure that there are that many stars out in San Francisco when it's dark. But basically, people were saying it was caused by an inadequate transmission grid and an over-reliance on intermittent renewable energy, and obviously natural gas challenges from their generating plant due to the hot weather. Renewables, as we know, are intermittent and not always dispatchable, unlike coal or battery power, which is always on. But we have to assume that with the advancement in battery technology, that renewables will become dispatchable, 100% dispatchable and less intermittent. So we shouldn't just ignore that fact. Europe is most likely to continue with coal plant closures. Depending on what happens with America in the elections, America may pause its closures and the rest of the world may pause as well. But there will certainly be pressure building, and renewables are catching on fast everywhere. Even in India, who have recently stated that they will look towards non-fossil fuel sources, and there they specifically mention nuclear, hydro, and renewables. They want to see this accounting for 60% of their generation capacity by 2030. That's 9 years away. And that's it's a lot of capacity that has to change, but the intention is there. I think things will happen quite fast. And I think often we tend to ignore the fact how much can happen. We always tend to overestimate what we can do in a year or two, but we underestimate what can happen in 5 to 10 years. I think the tipping point is likely around 2025, when new renewable energy will be cheaper. So this is new build renewable energy will be cheaper almost everywhere in the world from both a capex and an operations cost perspective than existing coal-fired capacity. Now that is the pure definition of a stranded asset, when you can build something new for cheaper than it costs you to keep the something current going. The next slide reminds us that politics is ever present, but politics is often all talk and no actions. And the great quote, politicians in diapers should be changed frequently, usually for the same reason. Now, we know that Biden wants to spend around $2 trillion decarbonizing the US economy. And that is obviously bearish. But despite Trump's rhetoric, more coal plants and more coal jobs were lost under his watch than under Obama's watch. So, of course, the economy speaks louder than any of Trump's tweets ever could. The crucial issue for me is, in terms of the US elections, is what is the likely relationship to emerge with China? So I believe that Biden will likely seek to mend bridges, whereas Trump will double down, a strengthened Trump will double down on his economic Cold War, and will force China to focus more on their own domestic supply and consumption issues. I think a hot war is unlikely. I can't imagine that anyone is going to go to arms, but certainly there is significant forces at foot in terms of a Cold War, not only in terms of becoming self-sufficient, but in terms of currency wars that are starting to take place as well. Either way, going into the elections, we will probably see volatility increase in a week or two's time, because markets don't like uncertainty, and especially if there is a hung result or there's an indecision as to what the result is, things could get a little bit messy. But we'll see that happen soon. Of course, on the next slide, we have to say that you cannot ignore China. China remains the biggest bull or the biggest bear in the room. And as the saying goes, where does the bear sleep? Wherever it wants to. So if China was to become more isolated and inward looking, we would see probably decreased domestic power demand. They might not be doing as much trade with the rest of the world, and their factories might not be running as much as they used to. However, China has a very much of a buy local policy, and they're trying to drive inward demand. But we will very definitely see much more reliance on domestic coal supply. And we've seen issues with banning Australian coal imports. We've seen limited imports with a quota system. So all of this has been is exceptionally bearish for the global coal market. On the other hand, a more engaged and integrated global outward-looking China will see a higher domestic power demand, and possibly they will loosen their trade restraints, and possibly there will be less reliance on domestic coal supply. Although I don't believe that factor will go away, China is very committed to increasing its logistics from Inner Mongolia and Shaanxi province to get the coal to their power plants on the south and the east coast from their coal provinces. So that is actually on balance probably quite bullish for coal prices. So Biden, in actual fact, could potentially be quite bullish for coal prices. Recently, we've seen this very interesting situation emerge with the Australian coal ban. And we understand that obviously political relations there have soured around perhaps banning Hawaii from participating in the Australian 5G network, around finger pointing around COVID-19, etc. But we think this will be quite a short-lived factor. Already traders are finding their way around the ban and the quotas, etc. However, if it were to be prolonged, South Africa itself could benefit. But all of this could become completely irrelevant. Imagine a Chinese super major was to come into South Africa and scoop up the South African coal mines. After all, who else are the majors ultimately going to sell out to? The Chinese tend to own their own dry bulk fleet. So they're a lot more immune to freight prices than many other people in the world are. And of course, they have their own domestic coal-fired power stations. So China can effectively end up owning the whole value chain. And of course, China is very much more immune to outside criticism and pressure. I'm not sure that will always remain the case because China wants to have a seat at the global table, but it is certainly a possibility that they could simply just go it alone. On the next slide, we look at India, which is South Africa's most important client at the moment. And the continual threats from India is that they want to increase their own domestic production as well. Being South Africa's most vital export market, the sector that's probably the more important within that sector is the sponge iron market. But even there, they have said that South African coal prices recently were very high and were hurting the sponge iron sector. And they were exploring, as of a couple of months ago, cheaper coal from possibly Australia, Mozambique, Russia, etc. Coal of India has always wanted to develop its own reserves more, and there's a continual threat of private investment coming on board as well and driving production higher. India is already the second largest producer of coal in the world, but to the extent that they do, this is bearish for us. However, thankfully for South Africa, most Indian power customers are mainly on the West Coast, which offers a distinct ocean freight advantage for South African coal versus, say, for instance, Australian coal. And also most Indian coal reserves tend to be situated to the east of the country. So it's quite complicated logistics to get the coal across India from the east to the West Coast. So South Africa has a structural advantage in that regard. China and India both need higher quality Australian and South African coals. Now, when we say higher quality, we're only really talking about 5,500 net as received material, which typically even the higher ash material is good enough for them, versus the low quality domestic reserves that they have. So even if they were to increase domestic reserves, there's always an element that they would need to take from Australia and South Africa. So South Africa is strategically important in that regard. Then the other demand is coming from Southeast Asia, which is definitely bullish. And this is what a lot of producers have hoped for. Our traditional Asian buyers, Taiwan, Taipower has always been there. South Korea, Japan has always been there. Richards Bay was ultimately built in the 70s to service Japanese clients. We are seeing robust demand from them going forward. However, they are also under pressure to close coal plants. Japan is obviously looking to restore nuclear, and as is South Korea with its nuclear fleet. More promising for our exporters is rising coal demand coming from Thailand, Malaysia, Philippines, Vietnam especially. Vietnam is expected to build significant coal plant going forward. And interestingly enough, domestic coal for Indonesia is in a similar position to Eskom. Although it's a large coal producer itself, a coal exporter, they have a very high domestic coal demand. It's expected, or it was expected until recently, that up to 300 gigawatts of new generation capacity in Southeast Asian countries would have to be built, and then that would be coal-fired. This, of course, may change because climate finance and pressure on that finance is altering quite rapidly. Some of the Asian countries that may not be impacted as much include Cambodia, Laos, and Myanmar. Although these are really small in terms of the big picture. They're hardly a drop at the ocean at the moment. But of course, all of them are busy expanding their coal burn too. So Southeast Asia is a bullish factor. Moving on to the home front, in terms of South African production, and in the background, you can see our Google map where we've mapped out most of it. The fragmentation of the South African coal sector is a bullish factor. The 2030 coal landscape will likely look completely different to what it has looked over the past 20 years. Going forward, I believe there's going to be little budget for large-scale exploration or for mine expansions or for the restoration work that's required. This will probably lead to a large number of abandoned mines with plenty of coal reserves left in the ground. Drag lines, longwalls, continuous miner sections, all being very expensive to develop and maintain, are going to be, as I said, probably eschewed in favor of high grading reserves and having lots and lots of mini pits instead, to the extent that that's possible, of course. I think with the fragmentation, ultimately what it's going to lead to is that South African coal production will decline quite rapidly from around 2025 onwards. But of course, production has to decline, or it must decline, by at least 22 million tons per annum, because Eskom will be eventually retiring up to at least 10 gigawatts of coal-fired generation capacity by 2030. So it becomes a race between, does Eskom retire its capacity faster than coal mines are shutting down their production? However, there's going to probably be plenty of rail and port logistics available. I believe what should happen is that a spot market is the best solution to manage coal supply and demand going forward, because it's going to become very messy, very random, and not only for coal, but also for logistics. The best price is going to be achieved by a spot market. And that will ensure that both mining, in terms of the utilization of that coal and in terms of the utilization of logistics, it'll ensure the highest efficiency of utilization by securing it through a market-based approach. If we move on to the next slide, we said one of the last known unknowns is clean coal, or high efficiency, low emissions. Now, this is building power stations that have an efficiency. Most power stations in the Eskom fleet range probably around the 36 to 37% efficiency. Healy stations would increase that efficiency up to 48%. But unfortunately, I can't see that happening in South Africa. No new stations are going to be built, and the existing ones aren't going to be retrofitted. And besides, Healy stations will never be able to compete with existing natural gas, which ranges from 42 to 60% efficient plant. Then, of course, we have carbon capture and storage, which has been highly overpromised and highly underdelivered to this point. I think what holds far more potential is underground coal gasification. There are water issues around UCG, but I think UCG needs to be looked at in terms of solutions for the hydrogen economy. And that is a way of utilizing deeper underground coal reserves without necessarily releasing the carbon. But as I said, it does need to be looked at for water impact. Then, of course, I believe biochar can play a significant role, both in terms of mine restoration and in terms of creating new revenue streams. Biochar can be produced from pyrolyzing coal fines or coal slimes. And then, of course, you can activate the biochar and create activated carbon, which is in your toothpaste these days. It's in everything for water purification, and activated carbon sells for 20 times the price that coal does. So I think that is a significant potential. Biochar, obviously, the process drives off the volatiles, leaving you with a much higher fixed carbon at around 85%, and then possibly the balance of that being your ash component. The hydrogen economy is what everyone is talking about. Some people are talking about skipping natural gas altogether and moving to the hydrogen economy. And possibly that's the way South Africa may go. Certainly in terms of larger fleet vehicles, trucks will be fueled by hydrogen going forward. But I can't imagine your average car is going to be fueled. But certainly factories and other large installations might look at hydrogen. Coal can play a role there, but of course coal would be coming in terms of brown hydrogen instead of green or blue hydrogen. I believe this is something that the coal industry needs to explore very quickly, and it needs to possibly look at partnering with the platinum miners for fuel cells, and also understand that I've got a picture of the periodic table in the background. Hydrogen was the first element, carbon was the sixth element, oxygen was the eighth element. So once we had hydrogen and oxygen, the planet formed hydrogen and oxygen, we had water. But lithium and carbon were there first. And lithium is obviously needed for brain capacity, and carbon is there for life to be formed. So we are all carbon-based life forms. And I think possibly future generations may look at us and go, why on earth did you burn all that coal? I think there are significant opportunities when we look at some of the allotropes of carbon, whether it's graphite, graphene, diamond, all of these are likely to play an important role in the hydrogen economy. We're looking at diamond fuel cells lasting for 100 years now. So why not coal? Let's look at some of the new opportunities around coal. Right, but then moving on, we now want to look into the future, into 2040, because people need to make long-term decisions. So where do we go from here? That's just a mood slide. I think we are going to see a huge amount of destruction in terms of the crude and refined fuels. A significant portion of the global vehicle fleet is going to be electric, which of course means where is that electric power going to come from? Renewable activists would say, well, obviously from storage, but of course there will be an increased demand for power, and some of that may come from coal and natural gas as well. Of course, then there's hydrogen and green. We've talked about it, green, blue, and possibly brown from coal. In terms of South Africa's vehicle fleet, we're going to move much, much slower, and possibly maybe 10% of our vehicle fleet by 2030 to 2040 might have changed. That will mean that we will benefit from low crude oil and low diesel and petrol prices, because where else is the world going to dump their fuel that no one else wants? That will benefit South Africa's GDP to the extent that coal prices are trading higher. So exported coal prices are trading higher than imported crude oil, then our balance of trade is positive. So for us as a country, that's not actually a bad thing. However, by this time, by 2030, if we are going to see climate really playing a role, this is when it's going to start happening, because we are on the cusp of the feedback loops which are going to be experienced. So definitely within South Africa, we can probably expect hotter, drier winters. I'm talking more Gauteng and the east side of the country. We can probably expect hotter, wilder, and wetter summers. Now, this means rain and flooding, possibly. Flooding is bad for topsoil, but rain obviously needs to be captured and caught and utilized. The most valuable commodities in the future are going to be water and topsoil. I'm no doubt about that. There's a recent movie about soil, and they're saying we have 60 harvests left. So there's 60 years left of viable topsoil, which means 60 years of food left. When we think about this, when we think about survival, we must think about the rule of three. You can survive for 3 minutes without air, 3 hours in a harsh environment. You can survive for 3 days without water, and 3 weeks without food. Nowhere does it say you need coal or energy or other than the harsh environment, for instance, to survive. Now, coal mines can produce both clean water and great topsoil. Obviously, most of the topsoil that has been removed to date is dead. It hasn't been kept alive. But if that soil can be reactivated with mycelium, and we can get the soil food web going, and we may find that water and topsoil could become more profitable than coal. We need to look at, by 2030, by 2040, will there be a global ban on coal? Will countries have got together and outright ban coal? I can't imagine that's going to happen because China, India, the BRICS nations effectively will push back significantly against that. If there's no ban, will there be a race to the bottom? And we talked about in South Africa how this could play out specifically in terms of power demand destruction versus coal mines shutting down. Will there be a massive increase in freight prices? We're seeing the freight sector now looking to cover its carbon emissions or to go clean freight. And that technology to generate clean freight is going to cost significant amount. So will we see freight, bulk freight, recovering that through the price? What will the effect of that be on the South African FOB market delivering into India, China, for instance? Will the BRICS nations go up against the rest of the world on climate? South Africa obviously falls within the BRICS nations. And I imagine that if this were to happen, then the strategic political links between South Africa and China and India would only strengthen. And that could strengthen South African coal exporters' hand in terms of delivering into those markets. On the next slide, we look at the fragmentation, and we have to ask ourselves in the domestic side, is this going to lead to a new colonialism for our miners? As the large miners leave and as fragmentation happens, will the traders, will the Swiss trading houses, or will a large country come in, and will we end up becoming simple contract miners or price takers for our invisible new owners who are not affected by shareholder activism, etc.? Also, will those new owners also control the logistics? We talk about the Seven Sisters, who are typically in control of either rail or port logistics. And of course, logistics works well when you have far fewer players because you can get economies of scale. And she who controls the logistics and who controls the end customer in India, China, etc., can control those profit margins and control where those profit margins go. Unfortunately, they tend to be offshored and sit in tax havens around the world. Eskom may come under pressure to secure finance, and that may only be, possibly the only finance that may be available is green finance. Could this force Eskom to shut down its coal mines sooner than expected, or will they be able to keep running them later? If they are forced to shut down sooner, will renewables, nuclear, gas, be able to take up the mantle in the meantime? Unfortunately, the renewable industry is very frustrated at the moment because of the slow pace of the acceptances for new licenses. So we're not doing ourselves any favors in terms of building capacity. Now, we already believe that South African coal production is going to fragment and start shutting down, but will it do this before Eskom shuts down? If more and more South African production starts shutting down before Eskom itself may face a significant coal supply cliff come 2030. And I'm just mentioning this because tomorrow belongs to the people who prepare for it today. So we need to understand what all these questions might lead to. Thanks. Climate change specifically, coal miners ignore this at their peril. Forget about greenwashing. Coal miners need to start looking at creating their own profitable circular economies around existing coal assets because it's possible. In the background, I've got a map of today, and there's a spot around Pretoria today which shows the NOx emissions, nitrogen dioxide emissions. And typically you can go onto windy.com and you can see daily your NOx and your SOx and your particulate emissions, and you will always see a big spot of pollution drifting from Mpumalanga, depending on which way the wind is blowing, towards either Pretoria or towards Nelspruit. So people are going to start pointing the fingers when they can measure where these things are coming from. But coal miners can be part of the solution, not the problem. If you look at the work that the Banks Group has done in the UK, coal miners can start growing forests. They can draw down CO2 to offset their scope 3 emissions when they sell to clients. Forests will increase rainfall, local rainfall. They will restore soils. They can look at the opportunities that exist around their coal slimes and their fines. I've already mentioned pyrolysis into biochar and then into activated carbon, which is 20 times more valuable than coal itself. Acid mine drainage can be dealt with. Obviously, that's acid. Eskom fly ash is base. You put those together, you can start to neutralize water. Many coal plants have built water purification, and that can be something that can help restore and create a revenue stream. The future of mining could possibly be in phyto mining, phyto being plants, obviously. So looking at certain plants are heavy metal accumulators, specifically for nickel, and some plants at the moment are being planted around mining and processing sites. So then they obviously, through the course of growing, they suck up the toxins and the heavy metals, and then you harvest that plant and you extract your nickel, etc. Alternatively, you can look at myco or mycelium, being mushrooms, in terms of remediation to restore the local food web and revitalize topsoils. And there you can create farms on your mines, agri-value chains. You can start to get into food and clothing. Of course, coal mines can also play their part in renewable power. Mines that have even 100-meter or a 200-meter shaft, you can drop water down the shaft during the evening peak load period, and you can pump that water back up during the day when solar power is abundant. So there you can play in the pumped storage game. So there's many things miners should be doing. And of course, the just transition as well. Miners ignore this at their peril. All the previous solutions that I've talked about can help create jobs and restore local communities, because that is key. Unemployment in South Africa is a huge issue, and miners can play a significant role in terms of creating new value chains. And I think miners would be wise to study this particular slide, which is really where we want to move to, and understand that there's profit in nature as well. All right. Let's move on. That's enough of me getting on my soapbox. What we really want to know about is the supply and demand situation going forward out to 2040. So what we've done here is we've looked at Eskom's power stations, and I've looked at the IRP, the latest integrated plan for 2019. The yellow boxes indicate the estimated period when that power station is scheduled to close according to Eskom's submission in the IRP. I've extended that slightly, and in some cases up to 2 years, because I believe that this being South Africa, things tend to slide, and I think we will see this happen as well. So in the gray box, what I'm highlighting is the number of million tons per annum that will be taken out of the market as that particular station shuts down. So by 2025, we will see at least 10 million tons being taken out of the market. However, in that period also, Medupi and Kusile will come online. So there will be obviously an increase in tonnage required for that. Then by 2030, we will see a further 12.2 million tons being taken out of the market as Hendrina and Arnott potentially shut down. Those are the small to medium stations. Now we get into the big stations, which are obviously built later, and their capacities are higher. And as these stations now start to shut down, we see a significant impact by 2040 in terms of at least 50 million tons being taken out of the market in terms of Eskom's demand, which then leaves us from 2040 onwards, 2040 to 2060, 70, depending on how long we think Eskom's going to be allowed to burn coal for. That leaves us with the super stations, including Medupi and Kusile, out into the future. It also means that stations like Majuba, for instance, which are, there's issues around the coal delivery on rail. It means that a lot of your tide stations, which are fed by conveyor, are not going to exist. And there we need to look at logistics. Logistics is going to play a crucial role in terms of getting efficient coal to Eskom going forward. That is the demand destruction we see happening by 2040. What we've done now is we've sort of tabled our assumptions. These are our assumptions, I stress, going forward. And if we look at the 2020 column, I believe these are the numbers we're sort of targeting for this year. So exports, unfortunately, through Richards Bay will be down. Domestic power will be down from around 120 million tons. We're probably looking at 112 for this year. Sasol and chemicals and synfuels, much of a muchness, and the industrial and metallurgical sectors, much of a muchness. We've got more than enough production at the moment to supply this demand. Indeed, we're seeing an excess of supply in the domestic market at the moment. We will probably need to see at least 4 million tons being curtailed or shut in to keep that balance this year. If we then go out to 2025, unfortunately, I don't believe exports will ever see more than 77 to 80 million tons. I could be horribly wrong, of course, but I just can't see where the demand is going to come from. And of course, it will all depend on what the price does, and we'll look into that next. We then look at Eskom. Sorry, Shannon, if I can just go back to that table. In terms of Eskom's domestic power for 2025, there's a slight uptick because of the effect of Medupi and Kusile, even though some stations will have closed down by then. But from that point on, Eskom's demand, as you see in the numbers, decreases significantly. What we then see by 2030 is that there's a net decrease in production that would be required. So in 2030, by 2030, at least 14 million tons will have had to have come out of the market. Now the question is, if coal shuts down to more than that extent, if 20 million tons comes out of the market, then Eskom is going to face significant coal supply issues. And that will have a significant upwards pressure on the domestic price, regardless of what the export price does. So there's a table, and that's available for you to look at going forward. If we look then at the next slide, we look at the coal qualities. So this is the 2020 on the left-hand side, my estimate of what's currently being exported out of South Africa. We see the signature RB1 coal is really not what it used to be. The main marker coal for South Africa is RB3 at the moment. However, by 2025 even, and that's quite soon, being a bit bold on this, I think we will probably see the bulk of coal coming out at 4,800 out of Richards Bay. Now, the 4,800 is your 22.5 megajoule coal. Unfortunately, that is also the bulk of Eskom's demand, so centers around about that 22.5 megajoule coal. We see that in the next slide, Shannon, where I've broken Eskom's coal usage, and these are ranges, these are rough ranges, right? I'm not saying Eskom specifically uses these qualities, but these are rough estimates. And we see that Eskom's, the bulk of its stations are around the 22.5 megajoule gross air dried. These are your exports, but as I believe, exports are going to shift away from your RB1 and your RB3 towards your 22.5 material. So there's going to be significant competition at that point. If we then look at price, which is really where we want to get to, on the left-hand side, I've looked at the potential price pathway for Richards Bay coal. So I am actually more bullish than the current forward curve in the market, which is projecting around $64 by 2025. I believe possibly, remember, the coal market can be quite volatile. I believe we may see $80 again. I think we will see an increase in demand, but after 2025 is when we will start to see a significant global demand destruction happening and significant pressure on utilities worldwide to shut down coal, no matter what. And that will ultimately lead to a long-term structural decline in the coal price. Of course, by 2040, a price of $56 now is really, really painful, because you would have hoped to have seen inflation kick in by then. So that is very bearish long-term for the export price. On the right-hand side, I'm looking at the current 22.5 megajoule coal of around 370. I'm not saying that's the price Eskom pays, but it's roughly a relevant price. And prices are slightly inflated. And here I've highlighted in green 2 potential path outcomes. If Eskom does face a coal supply cliff and production shuts down faster than demand is destroyed, we could see Eskom's price significantly increasing up to 2035. And then as Eskom shuts down the bulk of its fleet, price will come off. If it doesn't experience that coal supply cliff, I think we will see prices inflate. And here you see prices are increasing, even though I've shown a downward trend, prices actually increasing slightly. And this is due to obviously the cost plus factor. Eskom's cost plus contracts never go down. They only ever go up because of inflation linkers. So that is, you know, I can argue obviously that a market would sort that out. But anyway, Eskom does need to secure long-term coal security of supply, and it obviously needs to have some sort of long-term price security as well. If we then look at the next one, I've graphed that, where we see the, and this is quite a scary graph. We are looking on the left-hand one in a rands per ton price basis Witbank. In red, we are looking effectively at the RB1 price. And then in the gray, we are looking at Eskom's 22.5. So what I'm saying in this graph is even with a weakening rand, and it weakens out to 21 by 2040. It may, of course, weaken more than that, but I've assumed it weakens out to 21 in the next 15 years. Even with a weakening rand, the price that I think for the export market will be lower, and this is for a higher quality coal than what Eskom will be paying for a lower quality coal in the same place. So what miner in their right mind would want to supply into the export market? Of course, there's an interplay here, because as tons are withdrawn from the export market, you would expect the price to go up. So I can't work out all of the dynamics as to how that might work out, but we need to understand that this is a potential risk that exists if, and this is a big if Eskom faces that coal supply cliff and coal shuts down sooner than that. If not, this is the situation I expect to play out, where Eskom's price continues to increase, obviously, at a more inflation-linked rate, and the export price stays weak. So there we have a couple of potential price pathways, and that is pretty much what I have for you. I have a last slide, I think, which is just really to say thank you for taking the valuable time out of your day to listen. I've gone over time a bit, and there's still some time for questions for those who would like. But just to say, if you go onto our website, under our research section, you can actually get a copy of our report on this, where we go into it in quite a lot more detail, and we provide more of the underlying data for you to chew over. As well as on our site, there's also our graphical information system, our database, which we've updated over the last year. And there we're showing all the coal fields, coal consumers, over 200 mines and projects, all the coal logistics and port infrastructure, as well as all of the Africa. And it's not just South Africa, but Africa in terms of power stations, coal, gas, hydro, nuclear, solar, wind, etc. So, and of course, if anyone has any requirements around resource finance, or wants to offer commodities into the market, or needs help with restoration or just transition issues, you know where to call. Please get in touch. Thank you very much for your time, and look forward to hearing from you all going forward. Over to you, Shannon.
Thanks so much, Bevan. That was really engaging. So many of our questions have come through on the chat. But before we start with the Q&A, I'm going to quickly launch a poll, which is on what people think the price prediction will be. So we've heard what your price prediction is. Let me launch this poll, and let's see what, I'll allow our panelists to vote as well. We can see what our attendees think the RB1 export price in US dollars per ton will be by 2030. You can give your answer there. And then also what you think the Eskom domestic price for 22.5 megajoule per kilogram coal grade will be by 2030. So I'll just give our attendees a chance to vote here. So it's more just for fun, but it might be some interesting information for Bevan to give us a look at.
Yeah, I'll quickly go and update our report based on this. Thanks.
It's important information. So we can see so far, we've had quite a few votes, and so far it looks like people are kind of between $60 and $80 a ton, and 500 to 1,000 Rand per ton for the Eskom domestic price. Right, we've had about half the people vote, so let's just give it a few more minutes, seconds.
Yeah, I would tend to agree. And as I say, I think certainly in the short term, in the export price, we will see price being quite bullish. Unfortunately, it can't really go much lower. Coal miners obviously have a floor price at which point they literally shut down below that. And that, of course, has the impact of driving prices back up. But of course, it's not to say that the market may not try to flush out those sort of higher priced producers.
Right. I'm going to end the poll here just so we can see what the results look like. I'll share those results with everyone. Bevan, you can have a look at that. We can see majority, 64% of people say $60 to $80 a ton, and 75% say $500 to $1,000. So it is in line with what you said.
Indeed. And then I see there's a couple of questions, yes. One from Martin. And the question from Martin is it possible to obtain blue or brown hydrogen competitively from UCG at less than 2 Rand a kilogram? So this is a little bit outside of my experience, Martin, but I mean, I can't see how UCG would be able to claim that it's blue. But brown hydrogen, I imagine as the costs of drilling are more competitive, then yeah, it's possible. And I suppose the real price comes in converting of the hydrogen and how much energy you need to apply to do the conversion. Now, if the mine itself is producing its own energy through solar power or whatever, that may become very viable. Certainly, I think that's something that needs to be explored. As to where else in the world it's done, I'm not 100%. I think Russia has got some quite advanced UCG operations at the moment, but I'm not sure. And then Clive Murray is the head of London Commodity Brokers. So welcome, Clive. Clive's been a big influencer in the coal market, asking the average cost of mining or cost of FOB mining plus logistics. So Clive, I guess if you were to look at the cost for your average South African coal miner, I think FOB, we're probably sitting at around 550 to 600, but of course the cost curve is quite steep, and of course the Eskom tide collieries, which are feeding on conveyor, which are your large scale open pit mines, are going to be much more on the low side of the cost curve, whereas your export only deeper underground mines are going to be more on the high side. Certainly some of those more expensive miners at the moment are above their cost of production. Getting it to the port is above the current market price, and they are certainly hurting. And I think that what this also speaks to, though, is the cost competitiveness of Transnet and RBCT. Obviously, having a long-term RBCT and a long-term Transnet contract is what is required to keep your costs down. But of course, it's interesting to see how that is going to possibly change going forward, because there's obviously pressure to bring in the new players. And of course, as the market fragments, are we going to let that logistics sit in the hands of a few traders or larger producers who own that logistics, or are we going to make it available to more people when we might see a more reflective market price emerge? There's a lot happening, I think, over the next 5 years in the coal market. It's certainly a dynamic place at the moment.
We had another question here from John, and he asked, can you confirm which entities will be junior mining entities? Is there a list of juniors?
It's difficult. I mean, on our map, on our GIS map, if you go to our website and you, I'm obviously punting that, it's $100. We have a list of all the juniors there that we've been able to find, but it is, unfortunately, South Africa desperately needs.
We seem to have lost you a little bit there. Perhaps that's on my side. Bevan, are you back? We seem to have lost him a little bit there. Just give it a few minutes, see if he comes back. Unfortunately, it looks like Bevan's screen is frozen. We did have a few more questions from people. I'll just wait and see if he's able to log back in. But if we're not able to get him back, we are able to contact you all after this webinar, and we can possibly give you some answers to your questions. We've got quite a few that have come through, but I'll just give Bevan a few more minutes to see if he can get back in. But in the meantime, if you would like more information about African source markets, or you'd like to subscribe to their weekly commodity note, or you're interested in purchasing one of the research reports, please visit the African Source Market website at sourcemarkets.co.za. I will include that link in the same email that will be emailed to you in the coming days with a link to this recording. It doesn't look as if we're going to get Bevan back, so I will just ask him if he would be able to respond to some of these questions after this event. But in the meantime, I would just like to say thank you very much to our speaker, Bevan Jones. It was a really informative presentation that he shared with us, and I would of course also like to thank all our attendees for taking the time to join the webinar. And as I said, if you'd like more information from Africa Source Markets, you can go onto their website, sourcemarkets.co.za. And then the recording of today's webinar will be sent to you in due course. And if you have any additional questions, please be in touch. You can reach us at shannon@creamermedia.co.za. Thank you very much for joining us, and we hope that you enjoyed this session. Thank you so much, and goodbye.